Trade smart, live free, day trader paradise.
So today we're going to go over the MACD. Now the MACD is one of the most popular used indicators in all of trading, but nobody really knows how to use it. So the whole point of us putting together a lot of these videos is to take something that you already use and to enhance it based on our own philosophies of momentum decay. Now you guys are used to the MACD being some kind of oscillating nonsense like this, where lines crisscross and they're jagging, they go up and down. There's an oscillator with dark bars and light bars, and you swear up and down that these are buy and sell signals, yet you've never made any money off of them. So here what we are to do today is to make a very, very, very short video and show you exactly how to use something like this to your advantage. Now we're traders of the modern day, and this is going to be the best thing that you've ever learned about something you never thought you could use. So let's go forward. First thing first, what does the MACD stand for? Well, truth, honor, and courage. I salute you, MACD. It's actually moving average in the convergence and divergence. So basically, when moving averages spread farther apart, they're diverging. When they converge, they're moving closer together. And a moving average is the average of price data over a certain period of time. And the whole point is to show that whenever the actual averages are converging of the two lines in the MACD, it is a value, and average is the name of the lines, and they are actually calculated from the price, and then it gives you that histogram, which is the difference between the two of them. The histogram is an oscillator, and here's some funny stuff that we wrote about an oscillator. Obviously, it's a table or fan moving left and right between two extremes. And just imagine a line going up and down around a chart labeled 0, and a midline, that's what they call it. So when you plot those differences, you get this fancy little histogram. So what's under the hood? You have 4 parts to it. The 0 line is a line that's equal to 0. The value line, which is the EMA 12 minus the EMA 26 of the price. The average line is the EMA of the value line, which is just a smoothing out. I'm going to show you on my mouse. So here is the value line. Here's the average line. And then the MACD is just the difference of these two. So basically, you throw price in an equation. You smooth it out with the yellow one, and then somehow you separate these two, and there's your average. And this is your histogram that comes out of it. So somehow, with all of these layers of average, this is supposed to give you a really rock solid entry point, right? Wrong. Because we all know that price lags behind, or that indicators actually lag after the price. Once you get these crossovers and people use them to buy and sell, the trend has already pretty much started moving, and you've missed a big part of the trade. So what is a histogram? A histogram is, like I just said, you cross over with these two lines. The difference between these two lines is a histogram. So the difference is the greatest, the histogram is the highest, yada, yada, go forward. But see, like, when we do our videos, none of this stuff really matters, because honestly, somebody can go on for hours and hours telling you all about this stuff. And honestly, that stuff doesn't matter, because what do you really want to know is how do you make money with this? Because that's all that really matters. So your traditional way of doing the MACD, a little trade execution plan here, right? Green circle is an entry, or circle is your entry. The solid red is a support line, and then the dash red is your manual trailing stop. Everybody knows this, trading 101. And then you get in, this is Apple stock, and a very popular and very highly traded stock. And you enter in when the lines cross and the histogram's above 0, and you exit when the lines cross the other way around. And you got in at 116, and then you got out at like 118. Congratulations, you made $2 on a $12 move. Womp, womp, womp. So let me just take a moment here to blow your mind and show you something that you've never seen before. And what the MACD actually shows you is convergence and divergence of a moving average. So it shows after the fact, because the data has been averaged and smooth. So in the real time, what do, right? Well, when you see these crossovers, most people interpret them as buy and sell signals. But when we look at a momentum analysis on our charts, we're not looking at price. We're looking at slope of price. That's what momentum analysis is. Momentum is D price over D time, and it's like a triangle, and there's the slope. Every instantaneous slope that you have creates a line that's sloped. And when you have these crossovers, this should blow your mind. Every time the MACD crosses over, it doesn't mean buy and sell signal, it means slope change. And these slopes are so accurate. The price bounces off of them. Doesn't even matter if it's 4 months later, the price touches it exactly again. And every time you get a crossover, you look at the price and then you see if that originally told you it was a sell signal, but look what happened. You gapped up, and not only did you gap up, but you gapped up and traded up with an even higher slope. There was not just more interest, there was exponentially more interest. So you were way upside down if you're looking to sell or short here. So every single time, again, you get these crossovers, I don't want you guys buying and selling. I want you guys drawing sloped lines and touch exactly up against the candle wicks. Get exact, because trading is a science and you are not guessing, you are getting as exact as possible. So again, this is a cross. Here's A. This is the slope of A. Here is a cross. This is B. This is the slope of B. And you can see it touches exactly down here. As the price is just kind of lollygagging around, you know it's going to touch at some point, and it does it with each one of these slopes. That should blow your mind, because actually at the pit and core of all trading is momentum analysis. This is how market making algorithms actually work, and this is how we make money trading. So let me show you how you actually use this to really make money. You're not buying and selling off of this crossover. Get this textbook that you learned this crap from and throw it out, because it does not work, and you know it doesn't work. And don't try to tell me that it does, because you know it doesn't. So now this is how it works. Not only do you draw these sloped lines at each time you get the crossover, you're looking for the new slope. When they're above zero and they're crossing and they're bouncing, touching each other, you're going to draw a new slope. And here's all you do when you trade. It is so exact. If you wanted to short, you're not waiting for the crossover. You're waiting for the blue to be under the yellow. So the blue is the the average line. No, blue is value line. And average is the yellow line. So average is the smoothed out version of this line. So whenever they're underneath, you're not shorting just yet. It's not the crossover. It's when this sloped line breaks. When you break below this and the blue is below the yellow, the MACD is less than zero, the histogram. Now you know you're shorting, and you only short to this line below it, the line that's sitting there from a month ago. And then you do the same thing here. It's so exact. You trade it exactly to the line. How cool is that? That's an executable trade that you use. And when we trade against these lines, only these lines. My entire trading philosophy revolves around trading support and resistance lines. We call these support lines when they hang out below the trend. That's it. That's all you need to know. And here's one more fun fact about the MACD. Not only do these little crossovers show you something cool along a sloped line, if you zoom really far in, like the hourly, 5-minute, or minutely chart, not only is it showing you slope changes when they're all above zero. See, here's one of those again, above zero, it bounces and it bounces and it bounces. You get this line that you can literally draw from here to here to here to here. It touches 4 times, and that's your dip to buy on, is that line every time. Well, on the longer term trend on a smaller time frame, these crossovers are actually bounces against that line exactly that you get. The crossover is caused by that moving average convergence or divergence. When they started to converge together and the trade moves the other way, they start to diverge, and that's why it crosses. This is caused by price, not the other way around. Price doesn't give you this to guess what price is going to do. When price is already taken off, this happens after the fact. Okay? So what you have to do is you just know that these tricks are there. And when you see that these things have crossed over, you need to go to the chart and draw a line and start connecting the tails of these candles. And that's how you're going to trade these things. Again, this is reiterating everything I said. Each additional ridge that you get underneath a very long mountain, it's like a sloped mountain, you get A ridge, B ridge, C ridge, and D ridge. Again, these are matching each one of these slopes. Slope change, slope change, slope change. And they're so exact, the price touches them exactly. And you trade off of those every single time. Very cool, right? Yeah, that's it. So I'm going to spare you the rest of your evening, because this was our video for the MACD.